listen-only mode.
Good afternoon, everyone. Welcome to the webinar. Thank you for joining us. It's a gloomy day here in New York. Hopefully you're warm and not too cold, and maybe not in New York. Today we're going to talk about how to manage risk in Q1 of 2017 and come up with some trading strategies. Before we get started, I do want to make sure that everyone can hear me and see my screen because we're going to use it a bunch. So Bennett, Hubert, Melissa, Michael, Margaret, everybody who is here, thank you for joining. Could you please type in a Y for yes if you can hear me so I can go ahead and start our webinar today. All right, looks like we are okay. Thank you for corresponding. Looks like everything is good. So without further ado, we're gonna go ahead and start. It's 2 days to the end of 2016. It's been a crazy year. But before we get into it, let me just show you this disclaimer about high risk investment warning and that trading on margin, especially in FX, can result in losses that may exceed your deposit funds. So you should always be careful about your financial health, about your risk management. That is actually essentially what we're going to talk about today, risk management. So before you decide to trade foreign exchange, you really have to carefully consider your investment objectives, your level of experience, your risk appetite, and more importantly, your risk tolerance, because there is a possibility that not only you will wipe out your account, you would also lose confidence in yourself, which is even worse than losing money. Because trading can be very profitable, but losing confidence will not be your friend later in life, right? So that was that. In today's agenda, we are going to first take a very brief look at 2016. What happened, what went down, what were the major financial and economic events. And then we're going to take a brief look, fundamental outlook to 2017. And then we're going to get into market sentiment and risk management, trading strategies, mainly from a technical point of view, for the reasons that I'm going to tell you later. All right, so it looks like we are getting to our capacity in terms of attendees. That's great. Welcome, everyone. All right, so first let's start with, the major events that happened in 2016 that basically rocked the markets, especially the Forex markets. We had a very interesting year in the Forex market. So one of the most talked about events was, of course, Brexit, the EU referendum. Not many people thought it's going to happen, but it did. For years, there had been conflicts between the European Union, the EU, and the Brits. The Brits were, some Brits were feeling like they had to do more work than the rest of the EU, and they felt it was unfair, and there was an anti-EU sentiment going on that eventually got strong enough to support the then Prime Minister David Cameron to announce a referendum just to he at the time obviously didn't think it's going to happen, but the referendum was set in June 23rd, and at that time, while pound was basically incredibly shaky in the anticipation of what's going to happen, but the real crash really happened after the referendum, and when the Brits actually voted to leave the EU. And that not only put a lot of pressure on pound, but also on euro as well, because when people saw that, exiting the EU is possible, then the French and Italians came out and say, hey, we want to leave EU too. So now there is an open door basically for these countries to also leave the EU. So that's why we saw also pressure on euro and euro crosses, and a struggle basically going on between the euro pound pair. It's pretty interesting because they're both basically incredibly volatile, incredibly shaky. More importantly, they're both kind of weak. So that is an interesting pair to look at. We're going to look at it in a little bit. And then we had, of course, the U.S. elections. And well, last year, if you've been with me from last year, I always said if Brexit happens, the U.S. elections, Trump is going to win. And then when Brexit happened, I was like, oh, I'm hoping he's not going to win, but he did win. So it kind of looks like the things that we think is not going to happen is happening in 2016. It's been a very crazy, interesting year. So, and also what we thought, what a lot of well, economists and analysts thought was that a Trump victory could bring down the markets just like Brexit did, but it actually was quite the contrary. After Trump won, immediately we saw a massive rally in the U.S. dollar and across U.S. stocks, which was interesting. And we are going to look into that. So the question right now is that, all right, is this rally going to continue? If it is, what we're going to do? Is there a chance of it going back down? If there is, then what we're going to do? So we're going to talk about all these scenarios in a little bit. So the reason why at the time,
let me check on that.
Oh, I don't know what my Siri is talking. I did not. I swear I didn't press anything on my phone. Anyway, so so Trump basically, the reason why economists were thinking that a Trump victory could crash the markets was his interesting ideas for the economy, his lack of well, resistance and saying things to other countries, for example, including China, and creating a trade war. Or he has no filters. He says whatever it is in his mind. And for a lot of economists and analysts and traders, that those were a little bit well, volatility creators. But when he won, there was a rally because, well, mainly because of his tax plans, which is very good for Wall Street traders. He's going to cut taxes on the rich, and that's going to be good for Wall Streeters, and they started buying. But another good thing for the U.S. dollar in particular was, of course, the Fed rate hike. And we've been expecting the Fed to raise interest rates a bunch of times in 2016, but they finally did it in December. The anticipation helped the U.S. dollar after Trump won, and then when they actually raised the rates, well, that also helped the U.S. dollar. And now we are at a point that we're going to think, okay, what's going to happen in 2017? Because last year, the Fed promised a whole bunch of interest rate hikes, but they did it only once. So what's going to happen this year? So that is going to be obviously in our minds going to 2017. Another major, well, topic, economic topic in 2016 was the global oil oversupply, which really impacted the Canadian dollar, because Canadian dollar and oil prices, they're correlated most of the times in terms of prices. So what happened is that, well, for one, lifting of the Iran's oil sanctions caused a lot of fears of even more oversupply earlier in 2016. But then Saudi Arabia and Russia, they kind of got together and hinted an output freeze. And then in April, there were speculations that there was going to be a freeze on oversupply, and that really pushed the oil prices higher because, supply and demand, less supply, more demand. That is going to increase the prices, and that's what happened. And then the OPEC meeting came up, and now we're seeing a little bit more recovery in oil that could actually continue in 2017. Right, and then one last, economic topic that rocked the markets in 2016 was China. China's economy has been growing steadily the past, I would say, decade, and they managed to surpass Japan from being the second largest economy in the world. China is now the second largest economy in the world, and they have incredible amount of manufacturing production going on. Their GDP is growing at 9%. So a lot of good stuff from that area. The reason why we look at China is because Chinese economy is correlated to commodity currencies such as Australian dollar and New Zealand dollar, right? So, but China has also been creating a ton of volatility in the markets too, and in 2016. And so, for example, Australia, whose economy is dependent on China's export demand, Aussie dollar tanked when because of all the volatility and cash printing of China, while other safe havens such as Japanese yen got stronger at the beginning of the year, the first half of 2016. That's what happened to Japanese yen, and then Aussie was down, Japanese yen was going up, and then people banks of China started the quantitative easing, printing a ton of cash in the markets, and that weakened the yuan, and that weakened the Aussie dollar, and that's where we are right now. Right, so now let's take a look at what's coming up in 2017. So it is pretty foggy. I just copy pasted this picture from the internet. I don't have the lawyer for that. So it's from 123RF. All right, so Brexit is going to perhaps finalize sometime in February or maybe in 6 months. There has been a bunch of back and forth with that. As we talked about, other countries are looking to seeking getting out of the European Union. Trump is going to take office on January 20th. That is the inauguration day, and that is when his words really are going to impact the markets and the global everything, political system in general. Oil is looking like it's going to continue to recover, from my understanding, oil companies in the U.S. And from what the Fed has said so far, we are at the moment expecting more rate hikes, but again, we really don't know. We can really not tell anything basically in advance, fundamentally speaking, until it happens. We don't know what they're going to do. So far, the unemployment claims, this week, jobless claims came worse than expected, but it has been better than last week. Unemployment rate is the lowest in a decade. GDP growth is all right. So U.S. in general is doing okay. All right. However, once Trump takes office, we don't really know if he is going to start a trade war with China. Is he going to buddy up with Russia? Is he going to nuke Syria? I mean, he's been talking about these kind of stuff. So we really don't know what's going to happen next. He has been talking about nuclear weapons. He recently just said that why doesn't America have more nuclear weapons while we have the most amount of nuclear weapons in the world? So we kind of don't know. It's kind of foggy. on the other hand, some people are hoping that he will tone it down a little bit once actually taking office, not using Twitter as much as he does right now, attacking other people. So really have to wait and see. And then again, on the other hand, the Democrats in the U.S. are definitely trying to stop Trump from doing whatever he's trying to do. So even if he is not going to take a well, for the lack of a better word, crazy route, there is a hope that Democrats will stop him from doing things that are a little bit irrational. All right, so these are the things that we're going to look forward to in 2017. But today, what I really wanted to talk about was risk management and trading strategies amid the unknown, when we don't know what's going to happen, what we are going to do. So for that reason, I'm going to now bring down this presentation, and we're going to bring up our chart to see how the market sentiment has been and what we can learn from it from here. All right. This is the dollar yen hourly 4-hour chart. Actually, just broke below the HMO class. Not very good news for dollar yen traders, including myself. But we're first going to take a look at the daily chart. So this is what happened with dollar yen in the past year. All my Fibonacci retracement levels are over here, so we have to read everything here. So what happened is that end of 2015, beginning of 2016, it broke below the Ichimoku cloud. And from there, it was basically downfall until we hit the resistance, the support at 100. It ranged at this level for, well, from basically June. This is June until, well, last month. So 5 months, which is very, this is what basically Japanese yen does. It rallies or it drops, and then it ranges. The last range that we had, it started end of 2014, and it lasted until so a year. So the range for Japanese yen, then it really moves in cycles. It's pretty probable. So it's very reoccurrence. Again, my series is on. So as we can see again, so here, even after the market crash, we had a downfall, then we had range, rally, then we had range. It kind of seeks out an level that it's comfortable, a comfort zone, and then it ranges. So that has been Japanese yen for us. So people who follow me in our Facebook group, in our trading group, they're probably, well, we have been bullish mainly on dollar yen, and we got in at different levels. We got in the moment it broke above the daily chart, and then I remain bullish on it. I have been in a bullish positions with dollar yen for over a year, and I've been just adding on as it's been going down. But as you can see in the monthly chart, dollar yen was supported by the upper band of the HMO cloud. So from a very long-term point of view, it actually kind of looks like that it could be creating a double top pattern here, right around here. A fundamental reason for why I'm still bullish on dollar yen until it reaches 120 is because, well, we are seeing more, and that is long-term, by the way, not short-term. And by long, I mean anywhere between 3 weeks to 8 months, 12 months, right? Is because I really don't see Japan getting out of negative interest rate territory anytime soon, while we are seeing more rate hikes coming up. However, we definitely have hit a resistance here at around 117. So this was a support before in 2015 and in 2014 also. So this 2017, and then it acted as a support again in 2002 and 2001. So this 117 level, which is basically almost where it is right now, is a support turned into resistance. And it is basically struggling to break above it. And since we've had massive rallies in the past 3 months, we kind of really see it coming that it's going to either range or even pull back to a level before it shoots back up. For example, even here, so let's take a look at how dollar yen has behaved before, after. So a ton of rallies. These are monthly candles, right? Then it sees a pullback, it ranges a little bit, it goes back up until it hits a resistance. So another resistance that we have is 124, right? So which has been basically the limit resistance for dollar yen in the past, well, over a decade now, 14 years, right? The last time it was able to break above this level was in 2002, and even then it wasn't able to go above 104. So it is very probable that if it does manage to go higher, well, 124 or maybe even lower than that would be the limit for dollar yen, unless something crazy happens, right? So that's what we are looking for in the long run for dollar yen. By the way, feel free to ask questions in the chat box if you have any. So what we're going to do with dollar yen in terms of risk management. Again, let's take a look at the daily chart. And so I'm going to use Fibonacci retracement levels, come up with some strategies that you can use, right, for dollar yen. And we already said that an important level that we're eyeing at the moment is 1, right? So right now, it kind of reached, it kind of has hit a resistance, is pulling back, and there is a good chance that we see more pullback towards a Fibonacci retracement level, right? The first one is 23%, right? Why? Because that's how the markets react. Markets move in cycles. For every up, there is a down. And even if, as I said before, our long-term outlook for dollar yen is bullish, but what goes up must come down, right? So we have all these levels that the pair go down to in the next few months before it shoots back up. I'm not saying that it is not possible that, for example, January 1st, we see a kick or a jump just because it's New Year and people are happy, start buying dollar yen. It might even reach 120 or back up to 118.50 the first week of January. We're just analyzing the market sentiment and what is probable. And as you can see, for example, even in this downtrend, when we were going down, we saw a lot of pullback correction, right? So these are the market waves, the market sentimental waves that happens all the time. It doesn't mean that you are in a wrong trade or the world. As I said, I got in by mistake. I got into a bullish trade back in 2015. And then as it went down, I just added up to my bullish trade. And now, even though I have I kind of managed my losing trade by hedging and by buying more. So now I'm actually in positive territory. So that's what you can do as well in terms of risk management. If you're already in a bullish trade with dollar yen, you could wait for it to reach 114 and buy more. If it reaches 111, then buy more. And then you just wait it out until it reaches, it kind of goes back up. And as you know, if you have read my books, well, 50% of natural retracement level is the most important level that is very likely to hold the pair if it breaks all these levels, which is kind of unlikely, I would say, at this point, right? So if you're not in a bullish position, well, then you can actually go either way. Right now, we have a bearish engulfing forming in the pair. The sentiment is kind of bearish because of the data that came out. For a short-term trade, we would switch into 4-hour chart, and you can see that it actually just broke below the Ichimoku cloud, which is another bearish signal. It hasn't confirmed yet because for a confirmation we needed to open below the Ichimoku cloud. We don't have that yet. So for a short-term trade, if you want to get into a bearish position, I would recommend that you wait. We only have one more day left in 2016. I really don't recommend starting a trade today or tomorrow because, well, it's a little bit too risky. But if it does open below Ichimoku cloud on the 4-hour chart tomorrow, you could consider getting into a short-term trade, targeting a little bit above 114, right? So maybe target, if you're in a short-term trade, I would target 115 or maybe even 116, right? So depending on how the sentiment is, and do a short-term trade that way. Or you can wait for it to drop to 114 and see how that level is holding up, and then get into a bullish trade, right? So the risk management part of it is basically not starting out very big because 2017 is pretty foggy, fundamentally speaking. So whichever direction you decide to go, I recommend not having high leverage, starting out small and see how it pans out, and then just add onto it. If you're in a country that you can go in the reverse direction, you can try that too. In most countries, including the US, you can't do that. You can only go in one direction with your broker. So for that, you can just add on to your current position. And you might know, I am a long-term trader, and I'm not a big fan of stop losses. So instead of stopping losses, I just add on to my position. So that's that for dollar yen. I can see that some people are just joining us right now. Welcome. So next, let's take a look at euro dollar. We're halfway through. All right. So with euro dollar, this is again 4-hour chart. I'm going to go back to daily, work our way towards the monthly, and then go back to 4-hour for shorter term trading strategy. So actually, let's start with monthly first. We want to know where euro dollar has been. So euro dollar is less cyclically, so the cycles are a little bit smaller compared to dollar yen. And there basically has been one massive cycle, well, two if you count this, since the beginning of the year. And even this massive cycle still has not completed yet. What we learned from this massive monthly chart of euro dollar is that there is 100% room for further drops, technically speaking. And from what we just talked about, from a fundamental point of view, it looks like further drops in euro crosses both points of views, fundamental and technical points of views, right? But the euro dollar did range for a year and a half between 115 and 105. 105 was our main handle, our main support level for a while. And between this, we actually did go up and down euro dollar, making a ton of pips, range trading it. But now it looks like we are out of the range because the pair finally broke below 105. I've been looking for a parity for euro dollar for a year, and it looks like we might actually reach it in 2017. The reason why is that, again, well, 105, right? The reason why 105 is important is because it's tested it a bunch of times. And so the next levels for euro dollar, we have to go way back, create a Fibonacci retracement level. And we will see that, well, from a very long-term point of view, our next support level is actually parity, which is 1, which means 1 euro equals $1. Very good time to travel to euro for Americans, or, well, anywhere else in the world. So, but that is a very long-term outlook, and I do believe that it could take some time. Again, if you are following, if you are a member of our investing group, you would know that right now we're actually eyeing 102.50. Right around here, because this was a support and a resistance back in the day when the euro dollar was actually all the way down here. All right. So strategies for euro dollar, going back to the daily chart. So it is actually contracting back up. So because of what we've seen with the euro dollar, and well, it is the end of the year right now. Nothing is kind of, so until January 21st at least, we don't have really crazy amount of catalysts besides, well, first day of January trading that could create a jump, just a irrational kickstart to the year. But other than that, until Trump takes office, we really don't have that much of a catalyst. And we could see euro dollar just ranging somewhere between 105 and, well, our new low and support level of 103.70-ish. Right? So there could be a range trading going on for about a month coming up. And in that, so if you're a short-term trader, you could just eye these two levels, right, and just go back and forth. If it reaches 105, so for example, personally, what I've done, what our Investive Trading Group members have done, is that we closed out our bearish positions because we did get into a bearish position after we broke below the HMO5 here. We closed out here, so we took profit. And then when it did break below 105, we got into new bearish positions. I got into bearish position here. I got into another one here. And now it's kind of my average is around here, right? And I might actually add on to it because I didn't go very high on leverage when I started out. So again, risk management for 2017, don't start out big. Do not start out big. Start out small and then add on to it, right? So I might add on to it at 105 reaches it. So once it reaches 105, again, that would be the lower band of the as well. So that is when it's going to be a little bit well, scary, because if it does get into the HMO cloud, then we have to come up with a new strategy. So far, this is what our outlook looks like. We have a bullish engulfing here because the US dollar kind of weakened today because of the data. So there is a good chance we're going to get back to 105 one more time. And that is a good time to sell or add on to our bearish position. And so by then, right, depending on its position comparing to the Ichimoku cloud, we can modify our target if it looks like it's just going to go back up, because now we have higher our average, our bearish average, then we can move our target from 102.50 if you want to just get out of it, if you think it's going to be too risky, if things like completely change with euro dollar, if, I don't know, like Trump comes out and does something, we don't know, if like something incredibly good happens for the US, right, then I'm sorry, if something incredibly bad happens in the US, then the US dollar could get weaker, and that could push euro dollar higher up. So if things like this come up as we move on to 2017, then we can just add on to it, bring up our average, and then move up our bearish target and get out with profit, with a tiny bit of profit, but not, well, too much, but at least. All right, so we'll also take a look at the 4-hour chart just to see what the market sentiment is. So it has already actually reached inside the HMO cloud. On the 4-hour chart, it is more visible how it's been ranging, basically. So consolidation is continuing, and as long as, well, if it does break above the 4-hour HMO cloud, that is when we can, if you are not in a bearish trade, right? This is not for long-term traders. For short-term traders, if it breaks above the 4-hour Ichimoku cloud, that is when you can get into a short-term euro dollar bullish trade targeting one of the Fibonacci retracement levels. So the first one is, well, the 23%. You already have it almost 105.40. This is short-term trade, and the second one, which is probably going to hold, is 105.84. This is short-term trading strategy if the pair breaks above on the 4-hour chart. All right. Okay, so we have 20 minutes. I'm going to cover another major currency, pound dollar. Another controversial pair. Well, pound has not had a good year, for sure. Brexit happened, and pounded. It broke below all-time lows. It went from 140 to below 120, and now it's just flirting with this new support level at around 122, 120. This is our new support zone between 119 and 122. So we talk about it when we look at the long-term trade. We talk about a zone, right, rather than a specific number. And so this month, for example, January has been crazy. It's been up and down, and now it's still kind of bearish, right? So it started here, went all the way up, and now it's moving back down. And what is next for pound dollar? This is the pair that I really don't know what's going to happen to. If Brexit happens, there is a very good chance that we will see pound dollar going even lower, 115. But so far we have the support, and we don't know what the negotiations between EU and the UK are really going to pan out. So pound dollar, we basically, for 115 to happen, we need another shock from the UK. We need further US dollar strength. So far, we're kind of looking at more dollar strength coming up because of the anticipation of Fed rate hike, right? However, as we said again, for 2017, things are not really clear. So with that, I mean, it has been just dropping. So the last time pound dollar just dropped was the crash, the 2008 market crash, and it dropped like crazy, like this. 1, 2, 3, 4, look, massive, even worse than what happened with Brexit. Like, look how much it dropped in 1 month, in October 2008. And then it kind of ranged, right, between, so it found its comfort zone. It ranged between 171 and 144, and 144 for the longest time was our support. And then Brexit happened, and then we saw that. So there's a good chance that if nothing, again, further crazy happens, if another market crash happens or a recession happens, we could see another range trading coming up for pound yen. Now, resistance, our main resistance for pound, I'm sorry, this is pound dollar, it's not pound yen. So our main resistance at the moment for pound dollar is 133, the 23% Fibonacci level. So this is the monthly overview. This is a very long-term range that could happen. But it kind of looks like the actual ranges between what's been happening. Well, this is the new range that is going to be more visible on the daily chart. Wasn't able to break above the Ichimoku cloud. And it kind of looks like that. Well, 128 even didn't reach it. But so about around 127.76 is our new resistance. Why? Because, well, it kind of tested it back in, well, after Brexit. It was a support. Then we had another crash, and then it acted as a resistance. So, and Ichimoku cloud is flat. However, we do have, well, looking at the daily chart, we actually do have a bunch of bearish signals. We have the Tenkan line has crossed below the Kijun line, broken below, or wasn't able to break above the Ichimoku. We did think that it broke above it. It was a fake test, so it kind of fooled us. We did go actually bullish trade for pound dollar, and we're still bullish on it. But unfortunately, right now the outlook kind of looks more bearish. We have a ton of indications, but well, today has so far been indecisive. But as I said, right now the support level we could see actually more. The cloud is kind of flat, so we could see more range going back and forth. The prevailing cloud is in the positive territory. So a range going on between 119 and 128. So if you are in any kind of trade, bearish or bullish with pound dollar, these are the levels that you want to keep an eye on. And if you're bullish, I would, if I wouldn't add on to this one because it's a little bit more risky. And if it does break 119, that is when we have losses and just exit because that would mean that pound dollar is just going down, right? So with pound dollar, our risk management. So this is one of the rare cases that I would consider taking losses and just getting out of it because of the unknown. But also we really have to see what the negotiations is and between the UK and EU. If other countries leave the EU, right, I would assume that would be better for the UK. So that would push the British pound higher up. So it's really, really unknown when it comes to pound dollar at the moment. Not go big with pound dollar if at all. All right. Okay, so that was that. Next, we're going to take a look at Aussie dollar. All right. Last time we covered Aussie dollar for this webinar was here. And we had a small level coming up, right? All right. So Aussie. This is the daily chart. Let's again go back to the monthly and see what has been going on. So looking at the monthly chart, what has Aussie been doing? What has Aussie been up to? Let's get rid of this for now, just to make it a little bit more clear what's going on. So Aussie has a very clear median price. It's 0.78. right? And it has acted as resistance a bunch of times in the past. And it is acting as a resistance at the moment as well. With Aussie right now, if you take a look at this, it kind of looks like it's ranging between 0.78 and support, which is also a previous support. It's actually lower. .69, right? So it was a support back here. It didn't quite reach it back here, but well, right now it's a definite new support for Aussie dollar. So Aussie, as we said, is a commodity currency that takes its cues from China as well. And if America and China go in a trade war, that could definitely impact the Australian dollar as well. And from a technical point of view, however, it kind of looks like Aussie is definitely under pressure, right? It's trying to complete this new cycle and its range. So that last time something like this happened and Aussie ranged was, well, in here it kind of ranged and then it went back up. So it's kind of like unpredictable. If you look at it, it kind of looks like it's actually forming a very massive angled double top, right? But the long-term uptrend kind of looks like it's come to an end, and the prevailing cloud is mainly downside. I'm getting audio problem. Can everybody hear me? Hold on 1 second. I can see that you've said something, but I can't quite see it. Sometimes no sound. Okay, so there definitely is an audio problem. Do give me a shout out when you can hear me, then I will repeat, okay? Yes, now I can. Okay, that's good. All right, so looks like the audio is back. So anyways, back to Aussie dollar. It is under pressure. It kind of looks like it's ranging right now. We have bearish engulfing formation, resistance at 0.78, and from a long-term point of view, we actually kind of remain bearish with Aussie, and we are targeting a little bit above 0.69, which is 0.70 for our bearish positions. It's a little bit easier to trade Aussie, I would say, at the moment. But today we did have up moves with Aussie, which is a good time to sell, right? So looking at the daily chart, it kind of did break above the HMO cloud, but it was very messy around here and just ranged for a while. And now the prevailing cloud, even in the daily chart, is to the downside. We have yet another a break below of the Tenkan line below the Kijun line here. So it happened before. It's happening again now. So a shorter term support here, as you can see, is obviously, well, the level that it went back up today. It's 0.71. So it wasn't able to break below it back in May. It went up, and then it's testing it again right now, right? So on the shorter term, like medium term point of view, Aussie dollar is a little bit mixed, right? So we have a long-term point of view, we have a short-term point of view. We have a bullish engulfing formation here, but then we have bearish market sentiment kind of formation. We have a double top formation. This is literally the neckline of a double top formation with Aussie, which started here. And if it does break below 0.79, that would just confirm our long-term bearish outlook on Aussie dollar, and could very easily then target 0.69. But so far, well, today at least, we have a bullish engulfing formation, which mainly was because of US dollar weakness. So it is a little bit vague. It is pretty mixed at the moment. For Aussie dollar trading strategy, I would wait. If you're not already in a position, I would wait. We're looking for a break below 0.71 for a medium-term trade. And if that happens, if it confirms the break below that, we can go ahead and target 0.6962 as our new bearish target. If you have lower risk tolerance, that your target could be lower. Exactly what the levels are for a bearish outlook, right? So a break below 0.71, 64. The first target for lower risk tolerance would be 0.70, 47, so basically 0.7050-ish, right, which is a 66% Fibonacci retracement level. And higher risk tolerance, that would be 0.6962. Another way to approach this is that you take partial profit at here and then wait for it and take the rest of it here. So that is for medium risk tolerance, right? But yeah, so for medium-term outlook, we need to wait and see, because right now is pretty mixed. Going to short-term outlook for Aussie, again, it's pretty mixed, right? It's below the Ichimoku cloud. It's being supported. So we have absolutely no signal for Aussie dollar today at the moment. All right, so let's take a look. We have 5 minutes. Let's take a look at dollar CAD. Unless you want me to go ahead and cover something that you really want me to. But so let's take a look at dollar CAD. Dollar CAD, we're going to again start with monthly chart and see what's going on. Monthly chart is, we have this massive double bottom, right? The dollar CAD, we talked about how Canadian dollar is correlated to oil. And as oil improves, Canadian dollar, the loonie prices go higher. That means dollar CAD goes lower, right? Because Canadian dollar is second. But then again, because US dollar was rallying like crazy after Trump won, or even before, because of the Fed rate hike anticipations, we did see massive correction with dollar CAD. Another important point with dollar CAD is that the neckline is here, right? Is at 130, and it did try to complete this double bottom back in, well, beginning of 2016. It went up to 146, but it was just a test. It went back down, and now it's regained energy. There was a pullback, right? Then it regained energy. Now is slowly but surely trying to make its way back up. The Kijun line is very, it looks like it is going to cross above the Kijun line. And we are above the Ichimoku cloud. Prevailing cloud is to the upside. So a bunch of bullish signals when it comes to dollar CAD, at least from a technical point of view. From the fundamental point of view, it's a little bit more complicated, right? Because Canadian dollar should be, especially if oil prices continue to recover, then Canadian dollar is also going to get stronger. Then dollar CAD would not be as strong of a bullish pair as, let's say, dollar yen, right? Because they would both be kind of strong. So with that, let's take a look at the daily chart of dollar CAD. So we had indications. We had the cross above the HMO cloud again with Investiva students. We got into a bullish position right after it broke above the cloud. We have yet again another indication, the Kijun line, daily Kijun cross above, daily Tenkan cross above the Kijun, right? But now it kind of again stuck at support level. I'm sorry, the resistance level right here at 130, well, 6-ish. And it could be forming actually a double top, which is not a good news for our bullish outlook. Another way to look at this is the channel that the pair is actually trading within, right? So let's go ahead and create this channel. So as you can see, after the major drops, now the pair is basically trading within the channel. So this could just be a range, not a double top, but this could just be a range. And as you can see, the prevailing cloud is actually kind of horizontal. So this is actually more probable outlook. I'm getting a request to extend the webinar because it's interesting educational. I would definitely try my best. The range is basically it's a channel. So what happens in the channel is just zigzags, right, between the upper band and the lower band. And so that means that even if it breaks above 1.36, then we have this angled resistance overcome when it comes to dollar CAD, right? So with that is the reason why our well, I am long-term bullish on dollar CAD as well. But if you're not that long-term, yep, there you go. So interestingly enough, this resistance level falls exactly on the 50% Fibonacci retracement. That kind of shows that how important the Fibonacci retracement level is, first of all. And if it does break above it, then we have this as a resistance, and second, we have the 61% FIBO as our second target, right? Myself, personally, because, again, I made a mistake at one point back in the day, and I entered a bullish position with dollar CAD around here. So I'm going to wait. I'm going to just wait it out for 2 years, even if it takes. So I'm just going to wait until it gets back up. But for people who have not made that mistake, we can now treat the upper band of the HMO cloud as a support. The lower band of the cloud is our second support. And then the lower band of the channel is our third support, right? So if we go ahead with the zigzag strategy, one way to look at it is you can sell now, which is not really recommended because we only have one confirmation. So sell now and get out at the upper band of the HMO cloud at 134, or wait for it and see if the cloud actually supports the pair. If it doesn't, this would be actually a great place to buy, right? If it doesn't, we can buy here and then target either, again, this 50% of the retracement level or the upper band of the channel, right? Which, well, at the time when that happens, probably is going to fall exactly at the 61%, right? Another way to look at it is just to see, and even if it does break below the HMO cloud, because the cloud is flattening, then we could see if the channel, lower band of the channel, supports the pair. And that is when we can again buy, right? Or add on to our bullish position if we've already bought around here. And well, we can either even lower our target, because now we're going to lower our average position and just get out once it reaches, again, one more time, the 1.36 level. All right. So yes, that was as much as I would love to extend the webinar. I do have another webinar coming up, so I would have to go. Thank you so much for joining us today. And well, Happy New Year. There's only one day left, one trading day left. 2016. I hope that you have been able to take profit. One last thing that I want to tell you is your taxes. If you're in the U.S. and you have to pay taxes, I'm not really familiar with the taxes in other countries when it comes to Forex, but you have to really see if you want to pay the taxes on your profits this year or last year, and that can determine if you want to take profit on your long-term positions in any kind of market this year or next year. Personally, because I'm looking to buy a house, for example, next year, I'm taking more of my profit next year so that I don't, so that kind of balances out my taxes. So, I mean, you really have to talk to your tax lawyer to see when you want to take profit. So anyways, Happy New Year. Thank you so much for joining us. Happy New Year from myself and Orbex team and everybody else. And I will see you in the new year, hopefully.